Hey everyone, welcome back to Corporate Decoder, the place where we break down the dusty financial reports of giant corporations. Today we're diving into Emerson Electric's latest proxy statement for their 2026 annual meeting, and let me tell you, this filing is packed with juicy details about how they're transforming their business and rewarding their top brass. Stick around because we're going to uncover the real story behind the numbers and see if Emerson is truly building a future worthy of shareholder trust. And hey, before we get into the nitty-gritty, if you love getting these kinds of unfiltered insights directly from SEC filings, make sure you've subscribed to the channel and join our growing community on Discord, linked below. Alright, let's kick things off with what Emerson's leaders are telling their shareholders. They're touting a major transformation into a global automation leader, largely fueled by acquisitions like Aspen Technology and National Instruments, while divesting businesses like Copeland. They're pretty proud of their financial performance this past year, highlighting adjusted earnings. Per S-Hair up 9% and free cash flow up 12%. They even boast a 69th consecutive year of increased dividends, and they're planning to return a massive $10 billion to shareholders through dividends and buybacks by 2028. Sounds like they're aiming for significant growth and shareholder returns. Now, let's look at the details of the upcoming meeting. It's happening virtually on the 3rd of February 2026. The main items on the agenda are electing directors, an advisory vote on executive compensation, and ratifying their accounting firm, KPMG. They're also proposing to declassify their board, meaning all directors would be elected annually, which is generally seen as a good governance practice. And importantly, shareholders will vote on a proposal to elect directors annually, a move Emerson's board is recommending against. Here is a quick snapshot of what is coming up for vote. They're asking for a vote on their director nominees, advisory compensation, and ratifying KPMG. However, they want shareholders to vote against the shareholder proposal for annual director elections, while also asking for a vote on their own proposal to declassify the board. Interesting how they're pushing for declassification, but opposing a shareholder's call for annual elections. We'll dig into why that might be. Let's take a look at the folks up for election and those continuing on the board. We've got 3 nominees for terms ending in 2029, and continuing directors serving until 2027 and 2028. What's notable here is that all directors are considered independent except for Lal Karsanbhai, the president and CEO. This means the board has largely separated CEO duties from board chair responsibilities, with James Turley serving as the independent board chair. Looking at the nominees, Martin S. Craighead, the former CEO of Baker Hughes, brings large company CEO experience and global business savvy. Gloria A. Flatch, retired coup of Northrop Grumman, offers operational leadership and technology insights. Matthew S. Levatic, the former CEO of Harley-Davidson, adds significant operational and global business experience. These are seasoned leaders with a strong track record in major industrial companies, so their expertise should be valuable in guiding Emerson's transformation. Then we have Mark Ablin, former CEO of Flowserve, who brings financial leadership and industry expertise. James M. McKelvey, co-founder of Block and founder of Invisibly Incorporated, offers a fresh perspective with his technology innovation and industry knowledge in fast-moving growth areas. And James Turley, the board chair and former CEO of Ernst & Young, provides strong financial leadership and corporate governance experience. And continuing on, Joshua B. Bolton, CEO of Business Roundtable, brings corporate governance and operational leadership. Calvin G. Butler, junior president and CEO of Exelon, brings large company CEO experience and industry knowledge, particularly in regulated sectors. And finally, Surendralal Lal L. Karsanbhai, the president and CEO of Emerson himself, bringing crucial leadership and industry insight. Laurie M. Lee, Global Marketing Officer at T, offers financial leadership and global business acumen. It is a board with a lot of deep and varied experience, which is exactly what you'd expect from a company undergoing such a significant strategic overhaul. Emerson emphasizes its commitment to good corporate governance, with an independent board chair, regular executive sessions involving only non-management directors, and a strong ethics program. They've made proposals to declassify the board multiple times in the past, but those proposals didn't get the required 85% shareholder approval. This year they're trying again, a move they say is in response to shareholder requests. They also have director term limits and an overboarding policy to ensure directors have enough time to dedicate to Emerson. The board takes risk oversight seriously, delegating responsibilities to committees. The Audit Committee handles cybersecurity and financial reporting risks, while the Technology and Environmental Sustainability Committee focuses on product, cybersecurity, and AI risks. This layered approach shows they're aware of the complex risks facing a technology-driven industrial company today. The Governance and Nominating Committee is focused on finding and recommending qualified directors, with a preference for those with experience in global business, technology, finance, and operations. They've even retained an external search firm, Spencer Stewart, to identify candidates. This committee also considers shareholder recommendations for director nominees, so if you have ideas, they do listen. Now, let's talk about how the directors are compensated. For fiscal 2025, non-management directors received a total compensation package that included a cash retainer of $140,000, plus restricted stock or units valued at $190,000. The board chair, James Turley, received additional retainers, bringing his total to $529,932. It's clear that a good chunk of their compensation is tied to stock, aligning their interests with shareholders. The Audit Committee plays a crucial role in overseeing financial reporting and the appointment of the independent auditor, KPMG LLP. They've been Emerson's auditor since 1938, which is a long time. For 2025, audit fees paid to KPMG were $19.8 million. With another $3.9 million for audit-related services, totaling $23.7 million. While that is a significant amount, it is not unusual for a company of Emerson's size and complexity. The committee's report emphasizes their thorough review of KPMG's independence and performance. The Compensation Committee is responsible for determining executive pay. They focus on a pay-for-performance philosophy with a significant portion of pay tied to the company's financial results and long-term stock performance. They engaged Equity LLP as their independent compensation consultant to advise on these matters. It's interesting that while the company's shareholders showed strong support for executive compensation in the past, the board is recommending on this advisory vote again. Here is where things get really interesting. This section details how Emerson executive officers are compensated. For fiscal 2025, their named executive officers, or NEOs, included President and CEO Lal Kassambai, CFO Michael J. Bowman, and others. Let's look at the numbers that drove their pay. Net sales were $18 billion, up 3% year over year. Earnings per S-Hair jumped 43% to $4.03, and adjusted earnings per S-Hair rose 9% to $6. Operating cash flow was up 11% to $3.7 billion. And free cash flow was up 12% to $3.2 billion. These are solid numbers, reflecting strong execution amidst their portfolio transformation. This table shows how Emerson stacks up against its compensation peer group in terms of market cap, sales, earnings, and employees. Emerson's market cap is $73.8 billion, with sales of $18 billion. Looking at the Emerson percentile rank row, we see they generally sit around the middle to upper middle of their peer group in terms of these metrics, which is a good sign for competitive compensation. Here is the big one, the summary compensation table for the NEOs. For fiscal 2025, CEO Lal Kassambai's total compensation was over $21.2 million. This includes a base salary of $1.5 million, a bonus not paid directly but reflected in a $3.7 million non-equity incentive plan compensation, and a massive $15.4 million in stock awards. This clearly shows that the vast majority of his pay is tied to company and stock performance rather than a guaranteed salary. This table details the incentives awarded in 2025. For CEO Kassambai, his target annual cash incentive opportunity was $2.6 million with a maximum potential of $5.2 million. His Performance Share Award, a key long-term incentive, had a grant date fair value of over $8.6 million, with a potential maximum payout of over $17 million. The large awards for stock, especially performance shares, are designed to strongly align executive interests with long-term shareholder value creation. At the end of fiscal 2025, our NEOs held substantial unvested equity awards. CEO Kassambai, for example, had unvested performance shares with a market value of over $9.8 million, plus restricted stock and ASAs valued at nearly $18 million. These, combined with his vested options, show a significant stake in the company's future performance. In fiscal 2025, our NEOs realized substantial value from their vested equity. CEO Kassambai, for instance, saw over $22.7 million from the vesting of performance shares and RSUs. This highlights how the company's stock performance directly impacts executive compensation. Looking at pension benefits, most of the NEOs participate in the Emerson Electric Company Retirement Plan, For CEO Kassenbai, the present value of his accumulated benefit is $659,000. While not as large as their equity-based compensation, these pension plans provide another layer of long-term security. Emerson also offers non-qualified deferred compensation plans, allowing executives to defer a portion of their compensation. For fiscal 2025, CEO Kassenbai had over $3.3 million in his deferred compensation accounts. These plans allow executives to save for retirement on a tax. Third basis, further aligning their long-term financial well-being with the company's performance. This section outlines what happens if an executive leaves the company or if there is a change of control. For CEO Kassenbai, upon a change of control, the potential payouts from his equity awards alone could reach over $41 million. This double trigger provision means these benefits are only realized if a change of control occurs, and the executive is terminated without cause or their role is significantly diminished. This is designed to protect executives and ensure continuity during significant company transitions, but also means a large payout is contingent on specific events. This is always a fascinating metric, the pay ratio. Emerson reports that the ratio of their CEO's total compensation to their median employee's total compensation was 402:1 for 2025. This means the CEO earned 402 times what the median employee earned. While this figure can vary widely between companies due to different calculation methodologies, it underscores the significant compensation gap between top executives and the average employee. This table tries to connect pay to performance over the last 5 years. It compares compensation actually paid to key financial metrics like net income and adjusted earnings. Per S-Hair, for 2025, compensation actually paid to the CEO was over $37 million, significantly higher than his reported compensation in the summary compensation table. This jump is largely due to how unvested stock awards are accounted for under these specific reporting rules, reflecting the increased value of those awards based on year and stock prices. While not directly used for pay decisions, it illustrates how stock performance heavily influences the reported value of executive compensation. The shareholders are being asked to ratify KPMG LLP as Emerson's independent auditor for 2026. KPMG has held this role since 1938, which is quite a long relationship. The audit committee feels this continuous relationship is in the best interest of the company, citing KPMG's overall qualifications and experience with Emerson's global operations. This is the board's proposal to declassify the board altogether, meaning all directors would be elected annually. They've proposed this before without success, as it requires a significant 85% shareholder vote. While they're pushing for this, they're also recommending against a separate shareholder proposal that also aims for annual director elections, arguing their own proposal achieves the same goal. Here is that shareholder proposal we mentioned, submitted by John Chevden. It asks for all directors to be elected annually and suggests adjourning the meeting for up to 2 weeks, if needed to secure the 85% approval for declassification. Emerson's board argues this proposal is duplicative of their own declassification effort and recommends voting against it. It's a bit of a standoff here. The board wants declassification, but opposes the shareholders' direct approach to achieving it, which is an interesting governance dynamic. Looking at ownership, it is clear the executives and directors have significant skin in the game. CEO Kassenbai beneficially owns over 363,000 shares, with a total compensation package reflecting substantial stock holdings and awards. All directors and executive officers as a group own over 1.2 million shares. This level of ownership generally aligns their interests with those of the company's shareholders, which is a positive sign for alignment. The top shareholders are institutional giants. The Vanguard Group holds over 52 million shares, representing 9.2% of the company, and BlackRock Inc. holds over 37 million shares, about 6.5%. These large institutional investors often have significant influence, and their voting decisions can be crucial. This section briefly notes a late Form 4 filing for CEO Kassenbai due to an administrative oversight related to a gift of shares to a trust. It is a minor hiccup, but it highlights the importance of timely reporting for executives. This part explains the logistics of the meeting and voting. It details how to vote by phone, internet, or mail, and emphasizes the importance of each shareholder's vote. It also covers quorum requirements and what happens if you don't specify a choice on your proxy. Your shares will be voted according to the board's recommendations. A crucial point is that only the ratification of the auditor is considered a routine matter for brokers to vote on without instruction, meaning shareholder instructions are vital for all other proposals. This section outlines the procedures for shareholders wanting to submit proposals or nominate directors for future meetings. It details the timelines and information required, including specific proposing shareholder information and requirements for director nominees. It also covers proxy access. allowing shareholders to nominate directors for inclusion in company proxy materials under certain conditions. Here we see the actual proposed wording for declassifying the board. It details how directors will transition from staggered 3-year terms to annual one. Year terms, this is the legal language behind the board's push for declassification. And finally, the reconciliations. This shows how Emerson arrives at its non-GAAP figures, like adjusted earnings, per S-Hair. They exclude items like amortization of intangibles, restructuring costs, and acquisition. Related expenses for 2025 adjusted EPS was $6. Compared to GAAP EPs of $4.03, it is essential to look at these adjustments to understand the actual operational performance versus these adjusted figures. For instance, the adjusted earnings per share row shows a $6 figure for 2025, up from $5.49 in 2024. This is a core metric they use to measure performance and likely influence compensation. So, what's my take on Emerson's latest filing? Emerson is clearly in the middle of a massive strategic shift aiming to become a software-heavy automation powerhouse. Their financials show positive momentum with strong revenue growth, significant earnings increases, and robust cash flow generation. The board and executive leadership seem to be rewarded handsomely, with a large portion of their compensation tied to company stock performance and ambitious financial targets. The sheer volume of equity awards, especially performance shares, underscores a commitment to aligning executive interests with shareholder value creation. However, the pay versus performance table reveals a significant difference between reported compensation and compensation actually paid, largely due to how unvested equity awards are valued. While this is compliant with SEC rules, it is something to keep an eye on. It means executive pay can fluctuate dramatically based on stock price changes. Also, the board's opposition to the shareholders' proposal on annual director elections, while pushing their own declassification agenda, raises a slight governance question mark. While the board argues their proposal achieves the same goal, it is worth noting the shareholders' desire for a more direct control mechanism. The reliance on a large number of acquisitions and the complexity of integrating them, as seen in the non-GAAP adjustments, also presents execution risks. But overall, Emerson seems to be navigating this transformative period with strong financial results and a clear focus on rewarding leadership tied to performance. Alright, that is our deep dive into Emerson's proxy statement. What do you think about their transformation strategy and executive compensation structure? Are they building a solid future, or is something else brewing? Let me know your thoughts in the comments below. If you found this analysis valuable, give this video a thumbs up, subscribe for more corporate breakdowns, and don't forget to join our Discord community. The link is in the description. Thanks for watching, and I'll see you in the next one.